Hey gang, so this is easily one of the craziest, wildest weeks we've gotten. We're not really in normal times, so I'd like to make a caveat when I say that higher yields are associated with a risk-on attitude. So we're going to be getting into that a little bit more later in this episode. So the recap of the week is 10-year yields higher by 50 basis points and S&P 500 futures rising by almost 6%. So let's take in a glimpse at the lay of the land last week. So what I'd like to call out to attention is that yields pushed higher almost every day. They had their fair share of volatility, but we got a all in all 50 basis point sell-off over the week, and that's quite a remarkable number for the Treasury market. And over in equities, extremely volatile. It was pretty much a roller coaster every day. So you had Monday up, Tuesday down, Wednesday up, Thursday down, and Friday up. One interesting thing to point out is that on Wednesday, when you got that steep rise in the equity market due to a 90-day delay in tariff announcement by President Trump, yields actually didn't quite react in a meaningfully wild fashion. So that's just something to note. Also, I have at the top of each day the Bloomberg headlines trying to recap what happened in markets. And you can see almost every day it's all trade and tariff headline related. So in summary, a lot of news flow and sentiment affecting movement in markets rather than our traditional economic data. All right, so the crux of this week's episode is exploring why did yields sell off so aggressively despite on days like Tuesday and Thursday when you had equities falling by 2% and 4%. So in other words, why are treasuries not performing like a safe haven asset? We want to ask what's different this time around. So I'll jump into a variety of possible explanations that's been discussed in markets out there. And I do think that these claims have merit behind them. So let's start with three of the main reasons in order of popularity from the shorter term side of things. Number one, I'd call it rebalancing. And you can think of that as a rotation from fixed income assets into equities by more rule-based investors. So if you have a diversified portfolio of some portion in equities and some portion in bonds, after equities take such a big hit, especially after falling from its all-time highs about 2 weeks ago, people might take this as an opportunity to buy the dips or move into equities and take profits on bonds. So you'd kind of see selling out of bonds and movement into equities. So that selling in bonds could be triggering the higher yields there. And just as a reminder, going to our classic bond price and yield inverse relationship, a lower price in bonds, which is associated with selling, would translate into higher yields. Okay, now reason number two would be supply concerns given the auction that happened this week. Now, an auction just means that the US government is issuing new bonds and borrowing money in the market. So more issuance would mean more supply, and going to traditional classic economic supply and demand, more supply would tend to lower prices. And as we've mentioned before, lower prices translates to higher yields. Reason number three is more technical, and that has to do with basis trade unwinds. So that just means when you get big swinging moves, that can force people to exit trades that they've entered before, and that can exacerbate movements in the markets, like what we've been getting this past week. So that's the camp of the shorter term drivers, and now the main reasons for the longer term drivers. Number one, selling by foreign investors. Now in economics, there's this thing called the balance of payments equation, and I have it right there at the bottom of the screen on the right side. So taking the US, for example, the US has a current account deficit or a trade deficit with countries like China and Japan. So what that means is that the US would have a financial account surplus with China and Japan. So now if the US imports stuff from China and Japan, the US sends money or US dollars to China and Japan. What does China and Japan do with those US dollars? Well, they might hold it in financial assets like treasuries. That's why we say there's a financial account surplus from the US side. And so if Trump wants to close that gap and get rid of the trade deficit and the financial account surplus by extension, that would imply an exodus from treasuries by foreign investors. So they would have to sell treasuries. And selling treasuries would tend to lower its price, and that translates to higher yields. So that's driver number one. Now let's look at driver number two, which is the US dollar as the world reserve currency coming under threat. And you can think of world reserve currency as just the dominant currency that's being used for international trade. So if Trump is very anti-free trade and wants to crack down on the trade deficit and thereby reduce the financial account surplus, that would mean treasuries would have a lowered appeal to foreign investors. So lower demand translates into lower prices. That translates into higher yields. So that's reason number two. And then the last one, reason number three, would be what the market likes to call the bond vigilantes, who are protesting a worsening fiscal situation on the US side. Now, bond vigilante may sound like a fancy word, but you can just think of it as the collective spirit of the bond investor who acts when it doesn't like what it sees. So one part is it's not liking that the US dollar as reserve currency status could be challenged, and that would manifest itself in higher government borrowing costs, as we've mentioned before, and that would put the US in a worsening fiscal situation. So if treasury yields are higher, that means the US government has to pay a higher interest cost on money that it's borrowing. And so from a fiscal perspective, that's a not good thing. And the other part would be that as all this trade war rhetoric starts ramping up, that would increase the probability of a recession happening. And usually when we get into recessions, that could mean a more likelihood for the US to resort to deficit spending, which is borrowing more to spend its way out of a recession and juice up economic activity. So how do you spend more? Well, you'd have to borrow more. That means more bond issuance. So flooding the market with more supply of US Treasuries. And then more supply begets lower prices, and that translates into higher yields. So you can kind of think of it as bond investors saying, you know what, I'm going to sell and get out of this asset because I don't like what I see, and I'm not coming back until the outlook improves. So that's all I have for this week. Please let me know if there are any questions. Thank you, and see you next time.